The bond market just blinked in Japan, and silver just answered. When people say Truss moment, they mean one thing. A government announces a fiscal shock, and the bond market refuses to finance it at the old price. In the UK in 2022, that refusal detonated the gilt market and forced a scramble for stability. Now, in late January 2026, Japan is flirting with its own version of that stress test. And if you own silver, you're not late. You're holding a lifeboat. Today, we're connecting three dots most people are staring at separately. 1. Japan's bond market is no longer an anchor. 2. That change can spill into US rates and the dollar through a mechanical chain reaction. 3. Silver is reacting like the escape hatch because it's tiny, physical, and already structurally tight. No politics, no ideology, just plumbing, just math, just consequences. And by the end, you'll have a simple checklist: what matters, what doesn't, and what to do next. The anchor just slipped. For decades, Japan was the world's stability engine for interest rates, ultra-low yields, massive domestic savings, a central bank that could absorb the market. That quiet era is cracking. In the last week, Japan's long end moved like a stressed emerging market. 10-year Japanese government bond yields pushed up toward the high 2% zone, the kind of level Japan hasn't worn in a generation. 40-year yields surged above 4%. The ultra-long end, the part of the curve that's supposed to be boring, became the headline. Those are not tiny moves. That's the bond market saying the price of duration is changing. And why now? Because investors were hit with a fresh dose of uncertainty about future issuance and fiscal funding, right as liquidity at the long end is thin. Japan's public debt is enormous. That's not a judgment, it's a fact of the model. When debt is huge, the bond market becomes sensitive to any change in the expected path of deficits, growth, and inflation. So when Japan's leadership floated a major tax relief proposal tied to a snap election, the market did what markets do. It repriced risk. The result? A fast rise in yields, a bruised yen, and a global market staring at Japan again. Why this gets called a Truss moment? Let's translate the nickname into plain English. A Truss moment is not about a person. It's about a trigger. Unfunded or unclearly funded fiscal promises, plus fragile bond demand, bars a violent repricing. In Japan's case, the proposal that spooked investors was straightforward: a 2-year suspension of the consumption tax on food with estimates of a multi-trillion yen hole without a fully spelled out funding plan in the announcement window. Markets don't wait for the PowerPoint. They front-run the funding. So the bond vigilantes showed up, not as a moral lecture, but as a mechanical trade. Sell bonds. Prices drop. Yields rise. And in a market as huge as Japan's, that doesn't stay local. Because Japan is not just a borrower. Japan is also one of the world's largest pools of savings. The grand unwinding mechanism. Here's the chain reaction. Watch how non-political this is. It's just balance sheets. Step 1. JGB prices drop. When yields spike, the existing bonds held by banks, insurers, pensions lose value. Step 2. Unrealized losses become very real pressure. Insurers have to manage capital ratios. Banks have to manage funding costs. Risk departments have to manage duration. Even if nobody sells, the math changes. Collateral values move. Hedges get adjusted. Margin requirements tighten. Step 3. They need cash and they need duration relief. So they do two things. They shorten duration at home, and they raise liquidity by selling what's liquid abroad. And what is liquid abroad? US Treasuries. Step 4. Foreign selling pressure hits US rates. If Japanese institutions sell Treasuries to stabilize domestic balance sheets, US yields can rise even if the US did nothing wrong that week. It's not a narrative, it's a flow. Step 5. Now you get the uncomfortable combo. Rates rising, currencies wobbling, and investors losing confidence in the safe asset story. That is the real contagion risk, not headlines, plumbing. This is why you heard the phrase Six Sigma volatility attached to Japanese bond moves. A Six Sigma event is basically the market admitting the models did not price this. When the most stable bond market on earth starts throwing Six Sigma prints, money managers don't ask who to blame. They ask where to hide. The BOJ dilemma in one sentence. Japan's central bank is stuck in the box every high-debt system eventually meets. If it hikes fast, it risks crashing bond prices and raising funding costs. If it holds steady, it risks a weaker currency and stickier inflation. This week, the Bank of Japan held its short-term policy rate at 0.75%. That number sounds small, but the shock is the direction. Japan is no longer the world of permanent zero. Even small moves change hedges, collateral, and the term premium investors demand for 30 and 40-year paper. Why the UK 2022 episode matters. In 2022, the UK didn't collapse, but a fiscal surprise plus leveraged long-end positioning created a margin call feedback loop. Yields jumped, forced selling hit, yields jumped again, until the central bank stabilized liquidity. Japan isn't a copy-paste, but the rhyme is the same. When a market is assumed stable, the first real shock can move it violently. There's another transmission path. The yen carry trade. When Japanese yields rise and the yen gets jumpy, global traders cut risk. That can mean selling US bonds, credit, and equities to reduce leverage. So even if you never trade Japan, Japan can still trade you. Why silver moves like a speedboat. Gold is the aircraft carrier. Silver is the speedboat. Silver's market is tiny compared to global bonds and equities, so small allocations can move it hard. And silver has a second engine: industrial demand, power, electronics, solar, data centers. So when bond stress hits, silver can catch two waves at once: flight from paper claims and real-world demand. That's how you wake up, and the nice, boring metal is suddenly triple digits. What would cool this down? 3 off-ramps can calm the panic. 1. A clear fiscal funding path that reduces issuance fear. 2. Better bond auction demand and liquidity at the long end. 3. Central bank communication or operations that prevent disorderly moves. If those show up, yields can stabilize and silver can consolidate. Consolidation is normal. It doesn't erase the regime shift. Why silver becomes the lifeboat. Now we pivot to the lifeboat. Why does silver react so aggressively when bonds break? Because silver is the exact opposite of the bond market. Bonds are promises. Silver is a thing. Bonds are huge and liquid. Silver is small and tight. Bonds can be created by issuing more. Silver cannot be printed. When confidence in debt wobbles, capital searches for no counterparty risk. Gold gets the first wave, but silver gets the violent wave because it's the high beta hard asset. Here's what you need to understand. $100 silver is not just a price. It's a signal that the system is repricing real stuff versus paper claims. And the setup into 2026 was already combustible. Industrial demand has been chewing through supply, inventories at major exchanges have been thinning, and premiums in certain regions have been flashing that paper and physical are no longer the same product. So when Japan's bond market started screaming, it didn't create the silver shortage. It forced the world to notice it. Paper price versus physical reality. Let's say this cleanly. You can own a silver IOU, or you can own silver. Those are different assets in a stressed system. In calm times, the market pretends they are identical because delivery is easy and trust is high. In stress, the difference shows up as widening premiums, delivery delays, position limits, margin hikes, cash settlement incentives, and sudden rule changes that protect the clearing system. Again, no conspiracy required. This is how clearinghouses survive. So when you hear silver is a lifeboat, the meaning is specific. Physical silver is the claim that doesn't need permission. If the bond market is the engine room of the financial ship, and the engine room is taking on water, your lifeboat is the asset that can still float when paper claims get questioned. What this means for your portfolio. Now, I'm not telling you to panic buy anything. I'm telling you the regime is changing. For 30 years, the playbook was buy bonds, and if something breaks, central banks cut rates and everything goes up. That playbook assumes bond markets stay functional. Japan is reminding the world. Bond markets can be the source of the break. If Japan's long end continues to destabilize, you can get higher global yields, weaker currencies, and a stronger bid for scarce real assets. That's the 1970s style trap people whisper about: inflation pressure plus debt constraints plus limited room to raise rates. In that world, the question isn't, is silver expensive? The question is, how much paper wealth is trying to squeeze through a physical doorway? The 60-second explanation for a Western audience. If you're explaining this to someone in the US or UK, say it like this: Japan has been the world's interest rate anchor. That anchor is slipping. When Japan's bonds fall, Japan's big institutions can be forced sellers of US bonds. That pushes US yields up. That stresses everything priced off US yields. And when both major currencies feel unstable at the same time, money runs to hard assets. Silver is the lifeboat because it's scarce, small, and already tight. That's it. That's the transmission. The election clock and the auction tape. There's a calendar element here, and it matters for volatility. Japan heads into an election on February 8th. Markets hate uncertainty, but they love timelines. A known date becomes a magnet for positioning. What you watch into that date is not speeches, it's the tape. Bond auctions. Do they clear smoothly, or do they tail with weak demand? Bid to cover and dealer takedown. Are dealers forced to warehouse duration? Intraday liquidity. Do yields jump on small trades, or is the market deep? Emergency language. Do officials start emphasizing orderly markets and stability? When long-end yields move on thin volume, that's a warning. It means the marginal buyer is stepping away. And remember, Japan's long end is where the leverage and the assumptions live. That's why the 40-year yield is the headline. It's the canary. What contagion looks like on your screen. Most people picture contagion as a crash. In reality, it often starts as weird correlations. Here are the early tells. 1. U.S. yields rise even on good risk-off days. That signals foreign selling pressure or hedging flow. 2. The dollar stops acting like a perfect safe haven. You can get dollar strength versus some currencies, but weakness versus hard assets. 3. Equity rallies start to feel thin. The market rallies, but breathes heavy. That's liquidity, not confidence. 4. Silver outperforms gold in bursts. That's the high beta lifeboat behavior, violent upside, then sharp digestion. So don't wait for a dramatic headline. Watch for the pattern shift. The one sentence that sums up 2026. The old world was, when something breaks, rates go down. The new world is, sometimes the thing that breaks is the bond market itself. That's why silver is acting different. It's not just reacting to inflation, it's reacting to trust. Your job is survival, not perfection. If you try to trade every wiggle, this market will eat you, because volatility is the tax you pay for holding an asset that isn't controlled by a spreadsheet. Your edge is not being the fastest trader. Your edge is structure. A position size you can hold through a 15% pullback without flinching. A plan for adding on weakness instead of chasing on strength. A clear line between insurance, physical, and speculation, paper exposure. If you do that, you don't need to predict the day. You just need to not get knocked out of the game. Quick myth busters. Myth? Japan's yields are still low, so it can't matter. Reality. It's the speed of change that breaks balance sheets. Myth? If the BOJ buys bonds, the problem disappears. Reality. Buying can calm liquidity, but it can't erase the math of debt and inflation expectations. Myth. Silver is only a speculative trade. Reality. In stress, it becomes a referendum on whether paper claims are fully trusted. One more tell. If silver climbs while yields rise and equities wobble, that's not a meme. It's capital hedging in real time. The battle plan. Here's your checklist. Simple, boring, effective. 1. Stop watching the silver chart every minute. Watch the bond market instead. Japan 10-year and 40-year yields. US 10-year and 30-year yields. USD, JPY. When bonds calm, silver consolidates. When bonds break, silver gaps. 2. Know what you own. If you own paper exposure, understand the rules, margin changes, position limits, cash settlement. If you own physical, understand the logistics. Premiums, spreads, storage, insurance. 3. Don't confuse price with availability. In stress, the posted price is the last trade. Availability becomes conditional. 4. Scale in with discipline. No hero trades, no max leverage. This is a regime shift, not a lottery ticket. 5. Keep your time horizon honest. Silver is volatile. It overshoots. That's why it works as the lifeboat, but it can throw you off the deck if you chase candles. Japan's Truss Moment is not a meme. It's the bond market flashing a warning light. When the world's most stable debt market starts acting unstable, every other market has to reprice. Silver didn't wake up one day and decide to be dramatic. Silver is reacting to the realization that the anchor of global rates is moving. So if you're holding silver today, you're not holding a get-rich-quick token. You're holding a piece of reality. And in a world where promises are getting repriced, reality is the lifeboat. If you want a follow-up, I'll do a dedicated bond contagion dashboard episode. What to watch each day, what levels matter, and what signals a true unwind versus a fake out. Until then, stay calm, stay liquid, stay disciplined. Hey.